You watch the chart. A massive green candle breaks out. You feel the pull to jump in before you miss the move, so you buy right at the absolute top. And the exact second your order fills, the market reverses. You are immediately trapped in a drawdown. The momentum you tried to chase is gone, and you end up market selling at a painful loss just to stop the bleeding. Instead of getting caught in that cycle, we are going to look at a systemic approach called the sneaky reload. This method allows you to safely buy that pullback at the 50% midline, putting you on the same side of the trade as the institutions. To execute this, you need 3 things active on your screen: a live NQ futures chart, the DRW True C liquidity matrix, and your live telemetry HUD. Trading on emotion guarantees you will always be late to the move. To succeed, you have to replace retail reactivity with institutional pre-planning. When the market suddenly expands upward, your first step is to simply observe. Locate that initial massive breakout candle on your screen. Looking at this chart, a distinct block labeled True C appears at the base, signaling institutional capital. Mid-candle, a dashed orange line plots the 50% equilibrium level. Following it right reveals a glowing orange badge, your precise entry coordinate. When multi-million-dollar algorithms drive price up, they rarely fill their entire position at the top. They deliberately leave resting limit orders sitting back at that 50% fair value equilibrium. So when that initial breakout happens, keep your hands entirely off the mouse. Let the price run and let the trap set. By identifying that 50% anchor, you are no longer guessing where to enter. You have a precise, calculated reload zone waiting for the price to return. After the breakout peaks, the price will slowly start drifting backward, inching its way down toward your orange price tag. This is where retail traders panic. They see the red candles, assume the trend is completely dead, and start selling. But institutions actually want this pullback, so they can fill those resting limit orders. To confirm this is a safe pullback, we check this split-screen chart, showing price on top and volume on the bottom. Notice how the volume bars shrink in height as the red price candles drop. That dropping volume is your proof. Big money isn't dumping. They are letting retail exhaust themselves. Now watch the trigger. The exact millisecond the falling price perfectly touches our 50% dashed orange line, a thick dotted line paints across the screen. This is the nested True C, or NTC, confirmation signal. It means the institutional algorithms are actively absorbing the retail selling. Your rule here is absolute. You only execute your buy order the exact moment that thick dotted NC line appears. Waiting for that specific signal ensures you aren't catching a falling knife. You are entering exactly when the institutional wall stops the retail panic, turning perceived weakness into an explosive advantage. With your position now open at the institutional discount, your immediate next step is securing the trade. Looking back at our chart, we place the stop-loss order right here, indicated by the solid red line, immediately below the lowest tail of our original True C breakout candle. Because you bought at the 50% midline instead of chasing the high, your stop-loss sits much closer to your entry. You have cut your point risk drawdown distance in half. Your live telemetry HUD panel automatically reads that tight risk distance and updates your critical payload field to exactly 1%. This critical payload feature dynamically adjusts your contract sizing based on the math. You maximize your leverage while ensuring you never risk more than exactly 1% of your cash account. From there, you let the engine automatically stretch your projected profit exits, mapping them out to target 1, then on to target 2, and finally target 3. By offloading those calculations directly to the HUD, you remove human hesitation. You secure a mathematically protected position with maximum efficiency. Let's review the setup. You avoided buying the top, you waited for the institutional discount, and you locked in your dynamic risk. The second those algorithms finish reloading their positions, they hit the market with massive volume, creating a violent upward surge. Here is that result on the chart. An explosive green candle launches straight from our 50% reload zone, slicing cleanly through target 1, target 2, and target 3. Stop panicking when the market pulls back. Mark your 50% institutional wall. Wait for the nested true C confirmation and let the algorithms do the heavy lifting while you surf the wake.